Improving Alpha Innovation in Investing, ESG and Technology with Michael Oliver Weinberg, in partnership with Vidrio Financial, is being sponsored by Alternatives Watch, providing a 360-degree view of investor mandate activity across alternative investments, and PEVC Tech, a community for family offices, private equity funds, lenders, and VCs using AI and analytics to generate alpha. Vidrio Financial is a premier data management provider, shouldering the responsibility for your data from collection to extraction, transformation, and enrichment. Vidrio monitors over 2,000 diverse funds, processing millions of data points each month. Discover how Vidrio empowers your institutional portfolio data by combining advanced AI and human expertise to yield comprehensive analytics on performance, cash flow, risk, valuation, and more. All delivered seamlessly through Vidrio's Data Management Hub. Save your investment team valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Hi, this is Michael Oliver Weinberg. We would like to welcome everyone to the Improving Alpha, Innovation in Investing, ESG, and Technology podcast series. Today, Scott Chen, Chief Investment Officer of CalSTRS, will be our guest. Listeners may recall previously, we had Scott's predecessor, Chris Ailman, on. So this is a nice transitional call. So listeners have a high-level sense of our roadmap for today. We'll start with some background, then discuss the usual. Investors and business leaders should be able to extract a great deal of value from Scott's insight. On that note, welcome, Scott.
Well, hey, Michael, thanks for having me on the show. I really am excited and honored that you would want me on.
Yeah, well, it's our pleasure, and the honor's all ours. Why don't you start with your background?
Sure. Yeah. Well, so for the last 6 years, I've spent my time at CalSTRS, first as the deputy CIO, and now as the newly appointed CIO for, call it, a month and 8 days.
Wow. Yeah. Go on. Sorry.
Yeah. No, I'm just really you're catching me in the first couple of months in the role.
Well, congrats, and thanks for giving us the time so early on. Well, why don't we start again for those who aren't familiar with CalSTRS, and to contextualize the discussion. What's the objective, and what is CalSTRS?
Yeah, and sorry, I didn't go quite into the background. I don't know if you wanted me to go more into my own background, but so the mission of CalSTRS is securing the retirement future of our California public teachers. That's K through 12 and community colleges. We have over 1 million retired and active teachers, and that's really our focus, is securing the retirement future. I always like to joke, and because I'm kind of deeply rooted in the mission. My wife, Heather, has been a teacher for over 30 years. And my joke is that if the fund doesn't do well, I might be sleeping on the couch, though that might happen anyways.
No, that's funny. Yeah, look, I'd love to hear your background, and as with the listeners. So why don't we start with your background?
Yeah, and so again, spent the last 6 years at CalSTRS, first as a deputy CIO, where I was really overseeing all the different asset classes, the investment side of the house. Now I'm the CIO, and so what I've inherited from Chris is both sort of our middle office and some of our back office functions and the operations, plus all the things I was doing on the investment side, as well as a lot more management of the board and total enterprise issues. So that's the past 6 years. I always like to say my background looks a little bit like a reverse pyramid. I'm at certainly my broadest point today with what I just discussed, but also helping to oversee over $340 billion in assets. We're the second or third largest pension fund here in the U.S. and the largest teachers retirement fund in the world. But if you go in that reverse pyramid, I started in my narrowest point on Wall Street, doing research at JP Morgan. And there I was just covering a dozen stocks. And then, I moved into the hedge fund world doing long short equity. So I was covering more call it a universe of a couple hundred stocks across many different sectors, but really investing in 30, a focused list. And then I got broader as I pivoted into the asset allocation world, eventually becoming the CIO at Sacramento County. It was about an $8 billion pension fund. And that's where I covered all the asset classes, so private equity, all the private markets, as well the public markets. And then I became broader, at the UC Regents. I focused on two things. One is overseeing their public markets or public equity portfolio, about 60 billion at the time, and the defined benefit pension fund, which was about 60 billion as well over that period. And that was $120 billion asset plan. And I got broader in the sense that I covered all kinds of different geographies. I was truly global with the global equity portfolio there. I also got some experience sitting on some of their boards, Los Alamos and Livermore Labs, and that gave me a lot more of a scope around different types of investors, like an endowment model, a DB plan, DC plan, and different plans that were run a little bit more akin to corporate plans. And then here, as I just discussed, I'm at my broadest point of that pyramid as the CIO at CalSTRS.
Yeah, makes sense. Yeah, that's helpful. That's what I was looking for. And now that you've succeeded, Chris, what are your, and again, I'm completely sympathetic to the fact you're only a month and a fraction into it, but what are your, in the new role, I should say, what are your leadership priorities and how is that expected to evolve?
Yeah. And so, I always begin with there are priorities as in my role that I'm always really focused on. One is the mission, and quantitatively for us in the investment team, to secure the retirement future for our teachers, that means that we must meet or exceed our actual hurdle rate of 7% a year. And so we've done that. I've been out, we released our returns. It's akin to 8.5% over the last 5 years per year. So I feel really good about that. The second objective for us, and number one is by far the biggest, but kind of a number two would be to beat our benchmarks. And that's been kind of a great story as well. We can go into some of the strategies we've executed, but it's really been a combination of building the expertise. We have an amazing team in each of the different asset classes so that they can select assets and managers at a higher level. And secondly, I think we've talked about this in the past in some casual conversations, Michael, the collaborative model and how we seek to bring more of our assets in-house or in the private markets, leverage our partners for similar benefits of cost savings, boosting alpha, and helping to control our risks better. So those are by far one and two, but I recognize as a new CIO, newly appointed CIO, that is, I had to come up with some priorities, to work with the board and the staff. I've identified four. Those are one, people, and I'm spending a lot of my time now with the leadership structure, our senior management team, how to structure that. Number two is building a shared vision with all the stakeholders, including the board, staff, as well as other stakeholders. And the third, and this is not surprising, is the continuation of being really focused on value creation. We can talk about in the past, the collaborative model, our very own strategic asset allocation, something a little bit on the newer end at CalSTRS, total fund management, but also thinking about technology innovation and how that might play in. And all those three things that I should stop at three, but I had to add a fourth, and that's change management, because a lot of the first three things I think are going to involve change management. So those are the four new priorities that I have. And that's really for a newly appointed CIO.
Well, you've got a lot on your plate there, and there's a lot for us to talk about in a brief period of time. Total fund management you mentioned, and that's become quite prevalent in among top allocators in the institutional world. But perhaps you could explain what it is to listeners and how you're going to implement it and why and what the benefits are and the risks. So I just asked you about 6 questions in one, but we can go back over any you don't get.
Yeah, you're gonna have to probably guide me through that, because it's hard for me to capture all the questions in one. But I think everyone is thinking about this a little bit differently, and so I can only tell you, the CalSTRS way and how we're evolving. But to me, it's really an untapped area of value creation here at CalSTRS. If you looked over the last 5 or 6 years, when I talk about value creation at CalSTRS, what I'm talking about is how much and by how far we're beating our benchmarks, as well as implementing the strategic asset allocation well. And so if you looked at the value we've added above our benchmarks over the past 5 or 6 years, it's north of 10 billion. And that number really looks fairly linear, which I don't think it will always be, but it's been going up and to the right more solidly as we go along. A lot of that is that what I talked about, that dual, like building the investment expertise, hiring the right staff, building our team out, and then the execution of the collaborative model. So if that's done 10 billion, I mean, as I think forward, I'm hoping the next 5 years we can triple that, right? And certainly this area of total fund management is an area where I think we can do that. And it's really about answering a couple simple questions, here at CalSTRS. I'll give you a few examples that hopefully will become or may resonate with you or others. Is that number one, we've got some major things going across the portfolio where all of our experts are moving towards. Private credit is kind of a simple example. I got 5 different asset classes today wanting to participate in private credit because it's a great opportunity for them. In some cases, that debt is right on top of the equity in terms of the returns. But also, you're either more secured or higher in the cap structure, so the risk is lower. But the question for me is, where in private credit should we be leaning into and leaning out of? What's the best for the total fund, the total portfolio? And so we're answering that simple question, I think, could really optimize and maximize the returns for the teachers, leading to hundreds of millions of dollars, right? Another quick example is, we spent the better part of a decade moving out of fixed income. We had forecasted returns of less than 2% in the way that we operate around fixed income. It wasn't too long ago, probably a year ago, the team was forecasting 6.7%. So over the last 12 to 24 months, we started flowing more into fixed income, moving up our allocation targets there, and that kind of decision, allocating away from, in this case, we allocated some money away from our hedge fund portfolio, which we thought, could generate a solid 4.3% and serves a certain role in our portfolio. But if we're right on that, if we're right on the delta of this, and we have the investment experts who I think could be right, then over the long term, again, that decision could lead to hundreds of millions of dollars of value add to the teachers. So those are a couple examples, but that's kind of what we're gearing towards. So we've spent the last, call it 3 years, kind of moving in this direction. I'd say where we are is we built the foundation and we're starting to implement that progressively. So, and we can get into the details if you want, but for me, the foundation was like, what do we need in policy? How do we, develop pacing across the private markets? How do we source liquidity, particularly from the public markets and how we operate? Then how do we structure the asset allocation? We now do an annual asset allocation and visit it quarterly with all the, the investment leaders of the various divisions. So that's a lot I just kind of threw out there, but I just wanted to give you a little bit of a vision. Where are we gearing towards? What are some tangible examples? And then how have we been starting to build this foundation?
No, that's great. That's exactly what I was looking for. But in terms of, I'm just curious on for example, the fixed income decision. Was that a strategic change, a tactical change? Was it, curious to hear a little bit of your thought process on that. I mean, obviously it was a good one.
Well, it felt good in the recent bout of volatility, but it was both, strategic and tactical, right? I mean, here the teams were getting together and working together on a relative value decision, right? And I think this is something where me as a CIO, I can look to the investment experts, to forecast, right? I mean, what do you think of your asset class returns? Has that changed? Is it much better than it used to be in the future, or in the future than it had been in the past, right? And then where could we source capital from, where the risk for the portfolio might look similar, right? For us, I mean, broadly speaking, and I'm just making it simplistic here, fixed income and our hedge fund portfolio, they both serve partly this role of hey, when the markets are down, it's a ballast or an offset to the portfolio. Usually those are hopefully up and less correlated, right? But we have one area that's generating a lot more return. So tactically, we have a lot of capability. And this was part of this, when I was saying about policy decisions, we created wider bands around our asset allocation to the degree that we can make tactical moves. It ended up being a little bit strategic too, because we decided to move the target up in fixed income at the same time, because we felt that that was warranted. But we have plenty of flexibility to do both. And that's what I think is part of the beauty. We talked about the value add, but I think another reason or benefit around doing or having this approach of the total fund is developing a more flexible and dynamic approach, right? So we can move with the markets. And I think that's ultimately going to lead to greater resiliency, in our portfolio if we're able to do that. Because, there's a lot of, the markets are moving very dynamically. There's a lot of risk out there. And so do we have the appropriate liquidity tools? Do we have the appropriate flexibility to move the portfolio when needed? And we spent, a couple of years walking through that with the board to change the policies to get us in a position to build the foundation. We've also done that with the teams as well to get to this point that we're at today.
Got it. And shifting gears to you and I have discussed a bit of the collaborative model. I mean, you're kind of alluding to that. Anything else on that worth touching on that might be interesting? Or
yeah, I mean, I think this has been a great way for us to implement. It was unique to us because I think all investment strategies are unique to the organizations. What are our strengths and weaknesses? What can we really sort of execute? And we accelerated that starting about 6 years ago, maybe in 2018 and beyond. The collaborative model for us went back a long way before that, and what we saw was a history of success, and so we wanted to accelerate that model. We're probably we're in the fifth or sixth inning of kind of a 9-inning ball game for us in terms of extracting value. I still think there's a runway, so we're going to continue to be focused on that. If I looked at, some of the latest reports, we reported on this annually to the board, we had started off with something akin to what we call 100, collaborative market transactions, collaborative model transactions. We had been north of 350, the latest check and growing. And I look at that as just, are the teams executing? And, to level set, the collaborative model for us was, again, this way of bringing assets in-house to benefit from cost savings, boost our returns, and also to help to manage and mitigate risk. So, presumably having more influence and control. Those that has been fairly successful. If we looked at the cost savings, roughly 1.6 billion we estimated over the last 5 or 6 years. So that's great. We're focused a little bit more on boosting the returns and mitigating risks. And in the private markets, this has been prevalent for us because we're leveraging our partners to help us. And I think that takes the form of us attempting to be the global partner of choice. We kind of turn this on its head. We're a big allocator. A lot of people want to do business with us. We're very long-term focused. We have staff that have been there a long time, so we execute. But even beyond that, we want to be known as some of the best partners. We want to be nimble. Like if you ask us to co-invest, we should be giving you a response same day or within the 2-week market standard. And so that's we've undergone this whole effort of kind of making our organization more nimble so we can do that, hiring the right folks. But I would say the next leg of the collaborative model is to do more sophisticated transactions oriented around more of this boosting the alpha, boosting the value add and controlling risk. So if I looked at the current period, that's trying to do more of more co-investments, more joint ventures, more sort of minority or majority ownership of organizations when it becomes strategic to us. And in those areas, we're creating a lot more value for the teachers. And what we've seen in the recent period, the last 18 or actually I should say 24 months and more, sort of losing track of time. But when we saw the interest rates rise precipitously, transactions in the private markets, went down 80%, right? And we're still living in this sort of low transaction world. And so having a bit more control around our liquidity or liquidity risk as we have more influence in executing the collaborative model and those types of transactions has been beneficial, for us in this environment.
That's perfect, but that's a lot on improving alpha via investing. So let's talk about the second cylinder of this sort of three-cylinder engine podcast. The ESG perspective. Where does CalSTRS stand from an ESG perspective?
And there's a lot of ways we can go because the ESG is a very broad topic. But for us, I mentioned kind of like the number one and number two, meet or exceed the 7%, fulfill the mission of securing the retirement future, 2, beating our benchmarks. We also have 3 priorities that, from a business perspective, facilitate, kind of number 1 and number 2. And so that's why they're branch wide and we focus on them. One is that collaborative model, which we just discussed. The second is the path to net zero. And the third is diversity, equity, inclusion. And so just touching briefly, because these are really broad topics, I'll just touch on them briefly. For number as we think about the path to net zero, it's really 3 things. Like, one is decarbonizing the portfolio in a way that lowers the risk. And you can have risks in both ways. If you decarbonize your portfolio before the market does, you might take on risk, right? And so
totally.
Our goal is to be on pace, with the market and above that pace, right? So willing to take a little extra risk in being ahead of the game. And so you've seen that, in some of the moves where we dedicate 20% of our global equity allocation to the low carbon MSCI index, which we can go into the reasons why we did it, but that's an example. The second prong is investments. And so we have investments regarding, climate change and the technologies, renewable energy, et cetera, across the entire portfolio. And we dedicate a specific area, the CIS private markets portfolio, because we found emerging areas that fell in between private equity and infrastructure that we wanted to capture. And so we're doing a lot on the investment side. I'm kind of forgetting the numbers, but I think it was roughly 50 billion or so. If you looked at the portfolio of our investments are in this investing, sort of directly or decarbonizing the portfolio. The third area is engagement. So we're trying to engage our partners, our portfolio companies on the risks surrounding this, to make sure that our partners are focused on it. And the same would be said in diversity, equity, inclusion. I think kind of follows a certain path. What about our own team? Since we're doing more in-house, we believe that diversity, equity, inclusion really leads to superior results. I mean, that's why we're interested in it, not because it's a great thing to do, which it is, and we're focused on the internal team and we're focused on the external team, so to speak, all our partners and portfolio companies, and we engage in the same way, right? It's how much do we have in investments? What about our own investment team? And then we engage the marketplace. I think you can look at how we vote our proxies and think about board diversity and the like. So that gives you, this is such a broad topic that I think we can go so many different directions, but I wanted to give you a quick overview of how we think about that at CalSTRS. And, the political environment we've faced ourselves, maybe just chatting briefly about that, because it's become more difficult for allocators like CalSTRS to operate in an environment where this has become political football. Our viewpoint is risk and return. And so we take this fiduciary lens. And because we've always done that, we're not changing our approach around the political environment. But I think what we found is that we just have to dedicate more and more time towards the communication of this. it can be a distraction at times, but we're trying to communicate in a way that hopefully doesn't become a distraction to the investment team. But I'll throw that out there because that's certainly a challenge that we're facing.
Yeah, I think you're in good company. I think it's a challenge among many allocators. And if I think back to when I was at APG, the Dutch pension, it was easy for us in one respect, or comparatively to you, it was easy in that ESG, or responsible investing, was one of the four tenets of our fiduciary duties. So it was risk, return, cost, fees, and ESG. So for many other allocators, it gets much more complicated. And especially to your point, as to how one balances, risk, return, and meeting pension obligations with ESG.
Yeah, absolutely. We get this question a lot too, just because it's become political football. And honestly, we haven't changed our approach. If you think about diversity, equity, inclusion, it's about talent, right? For our managers, for our portfolio companies, for CalSTRS, we needed the best talent in the world to achieve the best results. And somehow that's become political football.
Yeah. All right. Well, let's shift gears to the third sort of cylinder of this podcast engine, technology. So how are you dealing with technology and the challenges that accompany it, and using that to improve alpha? Or how do you plan on doing that?
Well, yeah. So Michael, this is an area where I think that CalSTRS has not, the investment division that is, hasn't really focused and dedicated the type of resources or strategic focus to create value. And that's why I think, to me as a new CIO, this is amazing, because I think this is another area. If I think about, the three biggest areas where we can add value, it's the collaborative model, it's the what we discussed in the total fund management, which is emerging, and this other area, which is even more emerging, which is technology innovation. Because for me, I want to be clear, technology for us will never be the competitive advantage, right? But what I hope is that we have inherent competitive advantages that are going to be completely magnified and enhanced, right? So if I look at CalSTRS, we've got scale, right? We've developed investment expertise across all the different asset classes. We have world-class partners, and all of those competitive advantages can become enhanced and better. Why? Because we're sitting on a mountain of proprietary data that we could, translate into insights, right? Our private equity division's looking at, hey, like how can we forecast cash flows better, through this lens of all the data that we have and collect, and if we could do that, we could be better at potentially selling in the secondary market, and then optimizing that capital and reinvesting it in higher return sources, right? So that is just one example of 43 different use cases that the team has on Gen AI, machine learning, and the like, and I think that as we're stacking them up from an ROI perspective, there's a lot of potential for us to generate greater returns through technology. That I think that, if I'd say like, hey, the collaborative model for us seems mature and we're executing, there's still runway. The total fund management, we're kind of in inning 2, perhaps. And if I think about technology, I think we're warming up in it's the pregame. We're warming up, but I think this could be a tremendous value add creation for CalSTRS. So those are probably the 3 biggest areas that still, I think, remain a bit untapped for the future. And I'm sure there's more than that, but it's just what are the biggest ones?
Well, I like your baseball analogies. I'm going to the Yankee game against Los Angeles of all teams tonight if it's not rained out. So
Wow,
that should be
that's going to be a great ball game.
yeah,
That's
it should be fun.
awesome.
Yeah, totally. If it's not rained out, but anyway, yeah. Look, I hear you. That's why when I asked you the question, I mentioned being at a pension fund a couple of times because obviously you have that challenge. And I obviously budgetary constraints and other constraints. But look, it sounds like you appreciate what you need to do and where you need to go with it. So no doubt, it's only a matter of time.
Well, I hope I think this is going to be a focus. That'll be a change for CalSTRS. The investment division hasn't, I think, to this this day really really focused and dedicated resources. But just as all things, one of the great things about being part of the investment division, and when we brought forward the collaborative model, is that there is a return on investment, right? As we were on the precipice of accelerating the collaborative model, we were drawing out plans of like, well, we're going to need more people to do more sophisticated transactions, and we could draw the line towards, well, what is this going to mean in terms of cost savings and value add to the fund? And the good news is the team really delivered on that, right? I mean, if you look back, north of 10 billion in value creation, there's 1.6 billion in cost savings, and we're going to do the same as we think about these other elements, right? Because we're in the business of mitigating risks, but generating as much returns as we can, and so I'm optimistic. I think that there's a lot for us to do here.
Speaking of returns. Earlier, you alluded to the sort of total fund management and the private credit, in some cases having comparable or higher returns to equities, but even being senior in the capital structure, which if is the case, is obviously, I agree with you, a no-brainer. Other than perhaps the liquidity trade-off, but where do you see the best opportunities, or maybe not the best, but interesting opportunities from an investment perspective now?
Yeah, I mean. I think this is a really tricky environment. I mean, early on, as rates went higher, you heard the old adage of, well, for a pension fund with, rates so much higher, it'll be easier for you to achieve the 7, right? The 7% of, if, the fixed income team was saying like, hey, we can do 6.7, that's getting pretty close, right? But I'd say, not so fast, because, with the rapid rise in interest rates, I still believe that there are a lot of asset classes still in transition, right? I don't want to call like, hey, we had this ZERP bubble, but the question a couple.
No, I agree. Yeah.
Yeah, I mean, the question a couple of years is, was this reset going to be orderly or disorderly, right? We kind of had that scare with Silicon Valley Bank, and commercial real estate was on the hook, like, wow, if the banking segment goes down, all these assets are coming to market. How's the market going to absorb this? Will we head into recession? But it seems like we're going through an orderly transition. But to me, what does that mean? It means logically, growth assets should moderate, right? And as in all pension funds, we're tilted towards growth to achieve the 7. So on the one hand, we're seeing great opportunities in yield and credit, right? Fixed income, private credit, the energy transition, which has like infrastructure kind of yield oriented facets to it, the digital infrastructure build out. But then I got this massive part of my portfolio that likely out earned in a period of zero interest rates. There was a period where, and I'm not picking on private equity, but private equity, there was a period where we did more than 27% a year in returns. And our long-term average is close to that 13 or 15%, right? So that really out earned. And how are they going to adjust to this interest rate world? Well, so far, what have we seen, Michael? They're not doing transactions. It turns out that the entrepreneurs are thinking, I should get that 10 billion, and now they're getting marked down to 2 billion in evaluation. So they don't want to exit. The same could be said in buyout land, right? So we still just haven't adjusted to this reset. and it could take years, right? I mean, if you looked at the credit crisis in '08, I mean, what was that reset was at least 4 years, right? So, I'm not arguing, but hey, we're 2 years into a 4-year reset. But, what I'm just saying is that I've got my portfolio, and I'm not alone in pension fund land, tilted towards growth. And I think that's got to moderate, unless something else happens. Like if we go back to zero interest rates, for example, which I don't believe is going to be the case structurally. So, this transition is going to take some time. We're seeing opportunities, fixed income, private credit, energy transition, infrastructure. But I think that the broader landscape is something to keep your eye on as well.
Something we talked about a lot on this podcast a couple of years ago, but less so. But but I think is perhaps relevant again, or still relevant. Inflation. Do you have a view, or do you have a house view, or how does that impact your investment? Obviously, you've mentioned a couple of times the 7% target and beating benchmarks. But any thoughts on inflation? Or
Well, I don't have a view on the short term, but I think over the long term, looking at interest rates and inflation, I think we went through an abnormally low period, right? And I think now we're in a normal period. And there are reasons to believe that this normal period will structurally continue because, we no longer have globalization, we have deglobalization. Well, that's a bit inflationary structurally, right? We have to deal with the energy transition. Well, that's, more than $100 trillion. And depending on how orderly that goes, for example, if you skew that towards the end of the period and then all of a sudden everyone accelerates the path to net zero, well, that's inflationary, right? And if you looked at the deficits around the world that were created through, the low interest rate, zero interest rate periods, there's large deficits. So are interest rates going to remain low, or does that put some pressure on higher interest rates, right? So I think there's some structural things here that should keep us more in a normal environment rather than getting back to this abnormal environment of, hey, I really believe we're going to get back into this zero rate, kind of ultra low interest rate, low inflationary environment. Now there's going to be cycles, right? I mean, I could be right in front of a cycle saying this where we go into recession, and obviously that's going to be disinflationary. But I think the broader, if I think long term as an allocator, I think that extraordinarily abnormally low inflation, low interest rate period is probably over, and we got to reset to what's normal, what's a normal interest rate and inflationary environment. I don't know if I'm shedding a terrible light on that, but that's the way we're thinking about it and how we're gearing our allocation, and that's behind some of the thoughts around, well, hey, fixed income, private credit, energy transition, infrastructure. These all look pretty interesting given the kind of that backdrop.
Okay, yeah, no, that's fair.
One thing that I did want to throw out there, it's not yet the case. I think there's still a little bit of downside left in real estate, but as I was saying, they're different asset classes that are resetting at different times. Real estate being, something that uses a lot of debt in their cap structure has been resetting, sort of before other areas, maybe, like private equity or others. And I think that we're getting, close to a point where there might be an inflection, right? Where if I look backwards, 2 years of real estate market down, I think that we're, a lot of those markdowns are nearing an end. Maybe there's another, call it 8% in the Odyssey to go down, but we're starting to see opportunities in that cap structure where, it may not, behoove us to build or develop something, but there are areas where we can help to restructure the capital structure and own things, whether it be in the debt or the equity portion, that make a lot of sense now. And I just mentioned that because I feel like it's not going to be long for now, and maybe there's a quarter or two left in these markdowns that people really ought to be thinking about rebalancing back into real estate.
Yeah, I couldn't agree more. I like yourself. I mean, I think the opportunity in distressed real estate is fantastic now. I literally was speaking with a couple of top real estate investors within the last week, and they agreed. I mean, particularly in commercial and office, and but I do think it's very much on an alpha basis, and you need sponsors or GPs or agents who have the ability to lease and operate and workout experience, or those. Is that sort of in line with the way you're
Yeah.
positioning yourself?
Oh yeah, you're spot on. I mean, and it's really coming from a lot of our partners. What CalSTRS does well is we do kind of build to core. And so, but we're seeing a lot of this, I would call like cap structure ability, and some of it's distressed, and some of it, the real estate itself is not distressed, the cap structure is distressed, right? So it's a really interesting opportunity if you can be a problem solver within a distressed cap structure, but own great real estate that could be core even. So that's an opportunity that we're seeing more and more of, and I think it's indicative of a potential turn as we look forward.
And then just shifting to the allocation, what's a red flag with a manager such that you wouldn't invest?
Well, and I'm going backwards here, because a lot of what I do now is I lead and work with people who are actually doing the investing. The decisions are under them. But I would say that, I mean, on a positive basis, I look, within people, staff or managers, curiosity, the ability to listen, the ability to learn. And the converse of that is, like, I hate when I see managers that have an inability to learn from their mistakes. They can't acknowledge them. And it's very difficult, because I think that's when you can get some really big out of pocket, going out of business type of situations. And also just, the hubris that might go around that, where, an individual or leadership is creating an environment where, the broader investment team is losing its voice, where there could be this diversity of thought and better risk management. And so that's kind of like the big no-no to me, is like, I'm looking for people that are curious, that really want to learn from the markets, that are listening to others, they're absorbing as much information and insight they can to make the best decisions. And so, to me, the converse is like, the no-no is like, well, if you don't show an ability to learn from your mistakes, or you've got a certain level of hubris that makes you not attuned to listening to others or in the environment, then I think that's dangerous.
Yeah, that's fair. And do you have a favorite book or one you've read recently that you like? Or it could be investing or non-investing.
I've read some interesting books. They're kind of more specific to me, but one of the things that I think, because I have a pretty long commute, and so I listen to a lot of podcasts. I listen to a lot of Audible too, but this podcast I thought was really interesting. It was with Bill Gurley and Brad Gerstner.
Mm-hmm.
The podcast was BG2. I don't know if you've heard about it, but
Mm-hmm.
essentially, one of the fascinating things they were talking about was they were shedding light on this, the real kind of revenue and accounting behind the Gen AI hype, right? And noting that a lot of these very large companies have booked revenue by partnering with one of these startups that that they struck at a very high valuation, and the way they book the revenue is in future services, like future cloud services, for example. So that's not real revenue, right? I mean, that doesn't comfort somebody like me that's saying like, oh, well, I think this is Gen AI is based on huge demand, generating great cash flow, right? I mean, you're seeing that on the life sciences side with GLP-1s, right? That's actual demand and cash flow. Here, it's like, well, it's the future services that you get for that revenue, and so it's kind of like, I'm putting something from the balance sheet into the income statement, I'm kind of taking from the left pocket and putting in the right pocket, right? And I'm not saying like we shouldn't believe the future of AI, but I'm just saying that early in the starting point here, it's sort of interesting that a lot of that is based on this, something that I wouldn't really classify as like that's super solid and validates the theme. I'm sure that we do see validation in other areas, right? I mean, and certainly Copilot, it's been a very large success for Microsoft, and we're seeing folks coming in, thinking about using us and other partners for building out the infrastructure, whether it's the digital real estate, whether it's the power that needs to go into this. And so, I mean, there's validation points there, but I thought that was really interesting because a lot of this early on has been, I don't know how you describe it, phantom revenue.
Yeah, well, it reminds me of when I was a PM at Soros during the first tech bubble, sort of largely correctly bearish and lucky enough to get the timing right and not destroyed or anything. Yeah, I've been saying for some time over the last year or so, like I think VC is largely washed out, but the bubble is in AI VC, both AI publicly traded equities, so maybe some of the Mag 7, and then AI VC. I mean, and then I was laughing yesterday when I read an article which is sort of alluding to what you're saying and what I'm saying in the Wall Street Journal, which was about exactly this. The Wall Street Journal article here, I'm just looking as here. Shaky AI startups look for bailouts from big tech. So it's pretty much exactly what the two of us are saying.
Yeah, and I think that it's a reminder, right, that tech goes through cycles of over a correction on both ends, like ebullience and valuations, and then just sell-offs in terms of like the conception of the future. And here, I think it's just a reminder that there's going to be a cycle within this too, along the line of like, yeah, AI is likely the future, but there's going to be a lot of ups and downs, and the pace of this may not be as fast as people are predicting, because at the end of the day, I even think about this as we're getting inquiries of like building out the power, building out the digital real estate. They're going to have to show an ROI, right, to their investors and to their public investors. And there are going to be some bumps along the road where some people think, well, I don't know if you're generating the type of returns that I want you to. And so are you going to keep building out this infrastructure, or are you going to really need to show solid revenues and cash flows and the capability to generate real margin? So, more to come, but I think it's just a broad reminder, right, of like, hey, this is not going to go upward to the right forever.
Totally. Look, Scott, we pretty much ran out of time, but I'd like to thank you for the super interesting discussion and sharing your most valuable asset with us, your time. We hope listeners have a better appreciation for one of our more thoughtful allocators is thinking about and how we can all benefit from that as investors and allocators. This is your host, Michael Oliver Weinberg, hoping you join us again for our next episode, where we speak with another thought leader who will provide insight into improving alpha via innovation.
Thank you for joining us on the Improving Alpha Innovation in Investing, ESG and Technology podcast, presented in partnership with Vidrio Financial and sponsored by Alternatives Watch and PEVC Tech. Vidrio Financial offers a cutting-edge data management solution that not only collects and cleans your data, but also empowers investment teams to cut through the noise and extract valuable insights for better decision-making in areas such as valuation, risk assessment, and portfolio management. If you're an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office facing challenges with your data pipelines, we invite you to connect with us today and explore how Vidrio can seamlessly integrate with your investment team to enhance your data management capabilities. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial or our host, Michael Oliver Weinberg. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.